China and the US cut their 145% tariffs down by 115 percentage points for 90 days. US stocks and the US dollar charge ahead. Gold slumps and the Aussie and Kiwi fall, but by less than the US dollar rose. US Treasury yields rise, and so do oil prices on hopes for global economic recovery. And all eyes are now on US CPI data tonight. That's coming up in our 5 Things in 5 Minutes on Tuesday, May the 13th. And then, in our deep dive interview, as the China-US trade deal starts to progress, ANZ economist Sophia Angala analyses just how China's economic growth prospects mean more for Australia's export industries as opposed to its trade overall.
For Australia, what matters for its exports is how it is used within the Chinese economy domestically, rather than how its exports are used as inputs for Chinese exports of goods sold around the globe.
But first, in 5 and 5 with ANZ, the US and China have done a trade deal to de-escalate tensions, and they say they don't want to decouple their economies. Global stocks and the US dollar surged in relief. As of 4 a.m. Sydney-Melbourne time, the Nasdaq was up 4.2%, the S&P 500 up 3.1%, the US dollar index up 1.5%, and West Texas oil futures up 1.8% to $62.12 US a barrel. Now, offsetting that US dollar rise, the Aussie dollar fell 0.8% to 63.62 US cents, and the Kiwi fell 1% to 58.52 US cents. But obviously, that was less than the US dollar rose elsewhere. Gold fell 3.5% to $3,227 an ounce on less safe haven buying, and so did the US Treasury year prices, so that meant yields, rose 8 basis points to 4.45%. And the US 2-year Treasury yield rose 11 basis points to 4%. ANZ economist in London, Bansi Madhavani, says both sides agreed to bring their tariff rates down by 115 percentage points for 90 days. That means the US reciprocal tariffs, which included hikes of 125%, are cut to 10%. But there are still those pre-Liberation Day fentanyl tariffs of 20% and they stay. China cut its tariffs on US imports from 125% to 10%. Here's Bansi.
The announcement has come as a welcome sign of de-escalation. Remember, after the 2nd April tariff announcement, financial markets and analysts were worried that these tariff rates could push the US economy towards a recession. Now, there is still a lot of work to be done, but I think this announcement increases the hope that perhaps recession odds aren't that high and maybe inflation wouldn't rise as rapidly, and more importantly, that inflation would not be as persistent as feared.
Number 2. So what happens next with the Fed? Here's Bansi again.
Risk sentiment has improved and hopes are that this announcement can now pave the way for the Fed to cut rates. On that, we think the Fed will still remain in the camp of being patient. While the announcement is positive, they will want to see where the deal settles, what are the effective rate of tariffs overall, and what they mean for US's inflation outlook. So we are still of the belief that the Fed will cut in 3rd quarter, more likely at its September meeting.
Number 3. Currencies moved sharply in response to the trade deal, with the euro and Swiss franc, safe haven currencies, falling. The Kiwi and the Aussie fell, but by less, reflecting hopes for China's economy and robust global trade. Here's ANZ's head of FX research, Marjabeen Zaman.
What we need to think about is that a significant portion of risk premium on the dollar was really influenced by US-China trade tensions, especially because the initial tariffs of 145% was pretty large. But negotiations with other major trading partners are still ongoing. So while policy uncertainty with US-China has reduced for a while, it still remains. Now, despite the decrease in the tariffs or the pause that we have seen, the inflation and growth risk for the US still remain. So you could argue that this data may have marginally reduced the risk of recession, which has then been dollar supportive.
Number 4. Markets will focus tonight on US inflation data for April, with ANZ senior international economist Tom Kenny seeing a rise in core CPI inflation to 0.3% for the month from 0.1% in March. That would leave the annual core CPI inflation rate at 2.8%, which remember is still above the Fed's target, as Tom explains.
The primary reason that we think core inflation will accelerate in April is that the goods prices surprisingly fell last month, and we don't expect that to be repeated. Indeed, not with tariffs starting to more meaningfully impact goods trade from April. We've already seen some business surveys for April reporting a substantive pickup in cost pressures associated with tariffs. It's a question of how much of this might get passed on to consumers.
Number 5. Traders in Asia will be looking for Indian inflation figures later today too, with ANZ economist Dhiraj Nim expecting annual CPI inflation in April to be steady at around 3.3%, with food inflation relatively subdued. Core inflation will be firmer, Diraj says, but that's due to higher gold prices.
So excluding gold, we expect core inflation also likely remain steady. Now, what it means for monetary policy is that the overall configuration of inflation in India remains supportive of rate cuts, and we expect the RBI to deliver 3 more rate cuts in 2025 to be growth supportive.
Diraj Nim there. Now, in today's deep dive interview, ANZ economist Sophia Angala explains why the outlook for China's GDP is more important for Australia's export sector than Chinese trade.
So China is Australia's largest export destination for goods export. Total goods exports to China account for around 7% of Australia's nominal GDP. And the trading relationship between the two is largely reliant on resources exports, with iron ore, natural gas, and coal accounting for 77% of Australia's total goods exports to China through 2024.
So GDP matters more than trade. So what's happening with China's economy for that to be the case?
So we've started to see that Chinese economic growth is now more domestically focused. China's net exports take up a lower share of its nominal GDP, falling from a peak of 8.5% in 2007 to 2.1% by 2023. And alongside this, prior to the pandemic, domestic demand is what brought majority of China's domestic production. With economic growth now more domestically focused, it may mean that the Chinese economy is less impacted by shocks in export demand or trade uncertainty. For Australia, what matters for its exports is how it is used within the Chinese economy domestically, rather than how its exports are used as inputs for Chinese exports of goods sold around the globe.
So with that Chinese stimulus, what benefits are you expecting for Australian exports? Any particular sectors?
A Greater China team noted that package included an easing in monetary policy rates, including a reduction in mortgage rates. Stimulus directed to the property market or construction would boost demand for steel and therefore Australia's iron ore exports. We saw this happen in 2008 as part of China's response to the global financial crisis, where authorities focused stimulus on infrastructure. And the rise in Chinese steel production drove demand for Australian iron ore export upwards, and this was a key driver to Australia's mining boom. Whereas if you saw that authorities introduced further stimulus that was more focused on boosting household consumption and wealth, this would be less beneficial for Australian exports.
So what's the long-term outlook for Australian exports to China? What shifts do you expect?
Looking to our top export to China, iron ore, we continue to expect Australian exports to China of this product to remain robust as China invests into other sectors such as manufacturing. China also maintains significant stockpiles of commodities as a buffer against its scarce domestic reserves, and restocking is likely to continue as Australia is a major producer of high-grade iron ore, while China's iron ore is low-grade. Over the long term, Australia's commodity exports are key to China's pivot to decarbonisation and digitization, focus on electric vehicles or solar equipment. And this will structurally shift the trade flows away from iron ore and support demand for Australia's resources exports in copper or lithium, which are metals key to clean energy technology.
Sophia Angala there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, May the 13th. Catch you tomorrow with all the detail on those US CPI and Indian CPI inflation data. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.